Money FM 89.3. Best of breakfast. The Bigger Picture, only on Money FM 89.3.
Good morning. Welcome to The Bigger Picture. Me, Ryan Huang, and we are looking at what's playing out in the M&A space, specifically when it comes to private equity. And last year, we saw a pretty significant rebound fueled by evolving investment strategies and emerging market trends. So in 2024, PE buyout investments in the region reached $138 million US, and that marks an 8.1% increase from the prior year, and that was the second best year for PE deal making over the past decade. But with what's on the horizon when it comes to geopolitics, talk about potential recession, slower global growth, and all the trade tensions, what is in store for 2025? And to help us out, we have Sam Padgett. He is Deloitte Asia Pacific's private equity origination leader. Welcome to the show, Sam. How are you doing today?
I'm good. Thanks for having me here.
Awesome. Great to have you on because you look at the numbers very closely. So what are the numbers telling us about the outlook for deals this year?
Yeah, so firstly, if you look at last year, there was great momentum in the market. As you said, $138 billion deployed into buyout investments in the region, up 8%, but every quarter was up quarter on quarter. And if you look quarters 2 through 4, those were all up year on year. So good momentum going into year end. I think there was a lot of optimism at the start of this year. That being said, it may be getting tempered a bit with some of the policy and trade war talks that are going on, but the general sentiment in the market seems to be good, and everything is there for it to potentially be a good year, albeit maybe a bumpy year for deal activity.
Yeah, very bumpy year indeed with what's been going on in the backdrop. What are you hearing from clients? Are they more cautious? Are they holding back on talks? Are the timelines now being dragged out further?
Timeline for deal making is certainly extending, and this has been a trend that's been going on for a couple years because we're seeing fewer proper processes. Historically, you would always have a 2-round process, invite a bunch of bidders, get a first-round bid, a second. Those have kind of fallen out of fashion, and it's much more bilateral deals, a lot more talks behind closed doors, and as a result, they're taking more time to get deals done. But as I said, there's definitely optimism in the market. For about 5 years now, there's been a lot of pent-up demand with exits that have been stalled. First because public equity markets came down during COVID, then operational disruptions for COVID, then interest rates being high to fight inflation. So we've got a lot of assets that are sitting in the portfolios of big private equity firms that need to come out. And now we're starting to see maybe a better environment for that, aside from, as we say, some of the geopolitics.
All right, when we talk about private equity, what are we talking about? Give us a sense of the deals that we're seeing and where are they being made?
It really runs the full gambit. I would say over the last year to year and a half, there's been a big pivot into a lot of focus on Japan and India. And partly that's because some of the US dollar funds have pivoted away from China. But it can be any sort of deal. I mean, everything from consumer goods and retail to data centers to manufacturing. I think it's more playing on specific thematics. So, for instance, it could be corporate carve-outs. That's been a big source of deals in Korea and Japan lately. It could also be on kind of the picks and shovels for AI, so data centers and related services that have attracted a lot of interest, but really across the board.
So not necessarily IPOs or public listings?
No, as an exit route, that is one place that private equity will look, but it's never really been a preferred exit for private equity. They lose control of the valuation at that point because it's up to the markets, and it takes more time to sell down their stakes. So a clean exit or M&A trade is always the favorite exit, but also IPO markets have been relatively rough the last few years, and so it hasn't been a great exit. And I'd say that's one of the biggest concerns right now for a lot of PEs getting into new investments is how are we going to exit this in the future?
Yeah.
If we can't trust an IPO exit, if we're not sure if PE bidders will be there at our valuation, who are we going to sell to before we make the investment to buy a new asset?
Yeah, where are we when it comes to valuation expectations? Because we've seen the stock market go up pretty good in the past few years, pretty good run. How much of this market bullishness is translating to the expectations of exit valuations?
That absolutely transfers over. And one of the things that's held up transactions over the last couple of years is high interest rates. So that means the financing costs are higher for buyers and high valuation expectations. And that's partly because a lot of the owners of assets, private equity owners, have been keeping the valuations relatively high at kind of a pre-COVID valuation level. Those have both kind of tempered. Interest rates have come down. Some of the valuation expectations have dropped. But as you say, if you look at some of the market rallies, particularly in India, Japan, looking at those public market valuations gives sellers a kind of inflated idea of what they could achieve. Even though, as I mentioned before, a trade sale valuation would be very different from an IPO valuation because your ability to get that capital back is different. It takes longer through an IPO. It's less certain. So it's not necessarily the right benchmark to look at, but as you say, as they trade up, people look at those valuations and it may influence what they expect they can get in an M&A trade.
All right. So there is a gap between what sellers are hoping to get and what buyers are hoping to buy at. So what's the gap like? Is it widening?
It's been narrowing, but we're still talking several turns of EBITDA multiple potentially between what sellers are looking at and what buyers would like. And I think one thing that could ease this going into this next year is if we see more opportunities in market that are at a quote unquote discount, right, that are viewed as relatively fair value or cheap, there's a little more permission for you to sell your existing portfolio at a bit of a discount. Because if you're selling at a discount, but you're replacing at a discount, that seems more like a fair trade and you can rebalance your portfolio and give yourself, a new 5 to 7 year holding period for your fund.
Any sense of where the hot sectors are? I'm imagining AI is commanding high valuations right now, and maybe they are really on a bit of a run with all the talk about how it's the next big thing.
Certainly AI adjacent and related industries are all driving a lot of demand and interest right now. But interestingly, the broader Asia-Pacific private equity market is going through a bit of a rebalancing. Historically, for the last 2 decades, it's been very growth-driven returns, right? You were buying into high-growth countries, and as long as your asset grew, you would sell it and it would be bigger. Now it's pivoting to more of a traditional style, which is about operations value creation, so not so reliant on that top-line growth. So along those lines, there is seemingly a bit of a transition where we're focusing more on traditional industries. So you're seeing some focus on industrial manufacturing or kind of lower end consumer targeting the kind of value oriented local consumer, healthcare slightly more defensive, and even some more asset heavy type opportunities. So yes, there is some of this AI, but there's also a bit of this focus on more old school types of investments.
Okay, you've also got your eye on what's called zombie funds. Apparently there's a rise in zombie funds. What is it and why is it rising? What's playing out in this space?
The fundraising landscape has really tightened over the last few years. So there's less money going to fewer funds. I think it peaked for private equity investments in about 2021 with over 2,300 funds being raised. Last year, it was, I think, under 400 funds being raised. So a significant reduction in the number of GPs out there raising funds. And the dollar amount is similar as far as its decline. What that means is it's getting highly concentrated into some of the biggest names out there. So the top 10 private equity funds last year in Asia took 75% of the capital. So very concentrated into big funds, big brand names. For smaller GPs that operate in the small and mid-cap market, they don't see a lot of hope to necessarily raise their second fund and go out and keep investing. And what that means is there's not necessarily incentive for them to sell their current portfolio, right? If this is their last chance at running a portfolio, may as well keep operating it as long as I can and only sell for the best possible price because if they give dividends back to their LPs, if they exit their current portfolio, they're not necessarily seeing that money come back to them in their next fund. And that's the idea of these zombie funds that are sitting out there in the market, not really very active, but not also selling their assets.
All right, so these GPs are general partners sitting on assets until they see a better opportunity. All right, we've been in conversation with Sam Padgett. He's the Deloitte Asia Pacific's private equity origination leader, helping us out with a snapshot of what's playing out in the PE space, where perhaps there's still more momentum to go in 2025. Thanks for the time today, Sam.
Yeah, thanks so much for having me.
For everyone, stay on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.